Okay, year one. First of all, let me welcome you to Southeast Region Credit Union Management School, also known as Circus. Very excited to have you all in year one. Part of the year one presentations is going to be an all-day class on ratios. So what we will do for this pre-work is I'm gonna get us started on that. It's not going to be nearly as in depth as it will be when we're together for the better part of the day, but it'll definitely give you something to think about, something to start looking at and honing in on for your particular credit union. So on the screen, you have my email address, Tim Gardner 1125 at hotmail.com. If you have any questions between now and the time that class starts, please feel free to reach out to me. And then even after class starts, feel free to view me as a resource. What we're gonna get into, what we're gonna cover as far as an intro to ratios is here's some things that we can look at and start thinking about. Again, you'll see a lot more ratios when we get into the class. But when we think about ratios or when we look at ratios, one of the important things to start with is the fact that there's a numerator, which is the number on top, and then there's a denominator, the number down on the bottom, and the relationship between those two numbers goes a long way towards determining what happens with the ratio. And also, as we're going through this, you're going to see definitions of what a ratio is. So, for example, return on assets is defined as net income, that's the numerator, over average assets, which is the denominator. And even if you don't know what goes into all the numbers, the numerator, the description of the numerator will give you an indication as to which way you want that ratio to go. Because when a numerator has the word income in the numerator, when a ratio has the word income in a numerator, that means you want the ratio to go up because we want more income. If there's the word expense in that numerator description, that means you want the ratio to go down. So little things like that can make a huge difference for us as we're going along and looking at ratios. So when you calculate them, because you're going to have to calculate 20, you're going to have to calculate those 20 over the last 5 years. Just understanding what goes into the overall ratio a lot of times can help us start with, well, where do I need to start looking to figure out why the numbers have changed? And that's going to be the biggest difference in explaining or articulating the ratios is for those students who take the time to really delve into, well, what's the definition of the ratio and then what are the numbers? That's going to be a lot easier to explain why they change than other students who might just want to look at the trend line of the numbers and whatnot. So just something to think about as we're going along. This slide right here will show you or give you an idea on what happens when the denominator grows faster or is faster than the numerator. That's going to make the ratio go down. So that's the second line item that you see right here in this example. And then if the denominator is smaller than the numerator, or the numerator grows faster than the denominator, the ratio is going to go up. And again, a lot of it will come down to if the number is going up or down, depends on what kind of ratio it is. Is it an income-based ratio? Is it an expense-based ratio? Will help us determine which way we really want things to go. Ratios are very important to us, not only in credit unions, but in any industry, because ratios allows us to compare ourselves to other financial institutions that are of the same size, maybe they're a different size. For us at CDC, Federal Credit Union, I could compare myself to a credit union that's $6 billion, even though we're only 400 million in assets, and I can do that by using ratios. So that's what ratios helps us do as far as comparing ourselves to other credit unions. And then there's also the point that I like to make to all of the first year students. When you're wanting to move up the organizational chart, the higher you go in an organizational chart, the less it becomes about people and the more it becomes about the numbers. How do we impact the numbers? How do we get the numbers to change? So to use sort of a football analogy, it's more about the X's and O's, and it's less about the Jimmies and the Joes. The higher you go up, and another way to say that is, as I become more of a people leader, it's less that I'm asking, well, how is Tim feeling about the change in the organization, or how's Tim feeling about his job? It becomes more about what's our return on assets and how do we make that number go up? What is our loan growth? How do we make that number change, go up? So those are the kind of things that if you want to expand your leadership roles inside the credit union, that's some of the things that ratios can help us get at, is just looking at the numbers in a different way. When you look at the income statement, you have to we accumulate income and expenses over a 12-month period. And when we take months that are not at the end of the year, we have to do something that's called annualization. Now, you're not going to have to do this for your ratios project, because you're going to be looking at annual numbers already. So they've already been quote unquote annualized. So the reason I give this slide to you is because if you had income for January and February, and you were going to calculate a ratio, you would need to know that I need to annualize that income for the rest of the year. In other words, I need to assume that the income that I've made for January and February is going to be the same for the rest of the year. That's what annualization does. It allows us to take a period of time and assume that that's the same amount of money that we're going to make or spend for the remaining months of the year. So you can see here how to make that annualization happen. The biggest thing is to take the total income or expense that you have. So again, if I was using February as an example, I'll take January and February, and then I'm going to multiply that by 12 and then divide in the number of actual months that I have. And that's how I would get the annualization. So it becomes a little easier in the first part of the year, because if I take January's numbers, it would be 12, and then 1 divided into that equals 12. So I would take January's numbers and multiply it times 12. I take February's numbers and multiply them times 6. March's numbers get multiplied by 4. But by the time I get into August or October, well, now I'm into fractions. So that's why I give this to you, just so that way you can always have something in the back of your mind as far as how to work it out if I only get income or expense for a certain number of months. So here we go. I'm not going to go through all 20 of these, but I do have enough information in here for the ratios that we're going to go over to help you start to think about some of the things that you're going to have to calculate and explain or articulate when you do your ratios part of the project. So the first one that we're going to start with is net worth to total assets. So one of the first things to mention is when you see total assets in the denominator, the number down on the bottom, that tells you that's a balance sheet ratio. When you see average assets in the denominator, that tells you that it's an income statement based ratio. So that can help you figure out where am I supposed to go to get the numbers. Net worth to total assets is a big focus for the regulators. And so therefore, we in credit unions have to understand, well, why does the number change? And then be able to explain that to anybody that might be asking. So again, the definition to this ratio is net worth over total assets. Net worth is found on the balance sheet, and it is what we would refer to as capital or equity if we were in banks. So for us in credit unions, we don't have stock, we don't issue stock, we don't issue bonds. So for us, the only way that we can grow net worth for the most part is by net income. And so in the net worth section of the balance sheet, you're going to find regular reserves, which are statutory numbers, undivided earnings. Undivided earnings is how much net income the credit union has made since inception. And then you're also going to find net income year to date. So those are going to be the three things that you're going to use to calculate net worth. And when you do that, then you just take total assets. Because it's a balance sheet ratio, a balance sheet based ratio, that means that it's as of a point in time, just like the balance sheet. So think of the balance sheet as is a picture. It's as of a point in time. The income statement is over a period of time. The income statement is over a period of time. So the income statement is more like a movie because we accumulate income or expenses over a period of time. That's why when I get to income statement based ratios, which we're going to see quite a few of, I need to average the assets because I'm accumulating income or expenses over a period of time. So net worth to total assets is how we describe the ratio. And then this is what the net worth ratio has been over a period of time. And so as you can see for us in credit unions, our net worth ratio has been very strong as an industry, but this is basically the safety cushion. And so, like I mentioned, net income is closed out to undivided earnings. Well, if it's positive net income, it helps the undivided earnings rise. If it's negative net income, then undivided earnings are going to go down. And so that's why for us in credit unions, when we look at net worth, the actual dollar amount of net worth, what tends to drive that is how our net income is doing, how our bottom line is doing. So you can see that we've been fairly consistent as an industry. We tend to be over 10%. But then there's also when we have the numerator growing at a certain rate and the denominator growing at a certain rate, that can also change the ratio. So when we go back to 2009 as an example. So 2009 was when the credit union net worth ratio was 9.9%. The reason that went down is because we in the credit union industry were given a check or a bill basically by the NCUA to cut them a check to create a stabilization fund. So that way, during the Great Recession, if credit unions were to go out of business, we in the credit union industry, we're going to take care of those on our own. And so that cutting of the checks, that net income number, that decreased net income for that year. So the numerator went down, and then that meant that for a lot of credit unions, net income is negative. So then that caused the net worth ratio to go down in 2009. So just understanding again, I mean, some of the things that go on when you're looking at your actual credit union, you want to see when the net worth ratio changes, is it because assets have grown faster, the denominator has grown faster than the numerator, or has the numerator grown faster than the denominator? You could also start to think about well, what does the net worth ratio mean to my credit union? For example, at Tim Gardner Federal Credit Union, maybe our net worth ratio is 16%. And we can see that that's higher than peer. So is that where we want it to be? And if so, why? And that why, answering the why question is really what you're going to do a lot of in the project. So net worth is the rainy day fund. As we talked about, if something goes wrong and we have a negative bottom line, we're going to go to the net worth section to cover that. So that's how the ratio works. Then we can see by asset size. So you can see this asset size a lot. So credit unions that are over $1 billion are on top. Credit unions going down in the asset scale are coming down this way. So you can see that credit unions that are over $1 billion, their net worth ratios 9.9%. For credit unions that are in the $2 to $5 million range, their net worth ratio would be 17.2%. And there's not a right answer or a wrong answer as far as, well, how much do we need or how much do we want to have? But it does come down to, why is it that way? And do I have the ability to explain that? So don't look at just the numbers and describe why the ratio changed. I mean, it's going to be why. Why do we want it to be so high? Why do we want it to be lower than peer? Whatever the case may be, those are the kind of things that you're going to want to think about when we get into the net worth ratio. The next ratio is loans to shares. This shares is somewhat of a misnomer. When credit unions were started, the only type of deposit product that we had was regular shares. Well, now we have any deposit product imaginable. So the ratio is actually total loans over total deposits. And this ratio tells us what percentage of deposits are out in loans. Now that becomes something that we want to look at, because if I start to see deposits flowing out of the institution, and I have a lot of the deposits used to fund loans, well, I'm not going to be able to sell the loans to meet the deposit outflows. And so the higher this ratio gets to be, the less liquidity you might have at the credit union. And that's the primary focus for loans to share, the loan to share ratio. Or loans to total deposits. So when you're looking at this for your credit union, think about if the loan to share ratio is 85%, just as an example. So when we look at how that's changed over the last 5 years or 10 years, whatever the case may be, think about what types of loans have we started making at the credit union? Are there types of loans that we've stopped doing? And it doesn't even have to be types of loans. It could be dollar amounts. So maybe if our loan to share ratio has come down, maybe we've stopped portfolioing fixed rate mortgages or something like that. So think about the types of loans, and then also think about the types of deposits. When we think about when COVID was with us, when COVID hit, there we saw a surge in deposit growth because people weren't spending as much money as they had in the past. So therefore, when the paychecks came in, the money would just sit there for 2 weeks until the next paycheck came in. So the deposit base started to grow. So that could be something to point out. Maybe it's a different type of deposit product that your credit union has started to offer. Maybe deposits have grown, which would decrease. If the deposit growth is faster than the loan growth, that's going to decrease the ratio. Maybe that's because we've started offering, CD specials or something like that. So those why questions, those are the kind of things that you're going to want to get into. And, we can see just on the chart here. So back during the Great Recession, the loan to share ratios went down. Why did they go down? Because we weren't making as many loans. So that happened. And then we started making loans again. And so we start to see the loan to share ratio rise in 2017, 2018, 2019. And then COVID hit. We weren't making as many loans. And we saw the deposit base increase. So the numerator slowed down and the denominator sped up, which meant that the loan to share ratios went down. But again, when you're articulating these things, I don't I don't want you to think just in terms of, well, the number went down because deposit bases went up. That might be true, but more importantly, why? What was it that was going on? Our members just weren't spending money during COVID, so therefore we would expect that at some point they're going to start spending money again, and our deposits are going to go down. So just think about it that way. When you see the loan to share ratio based on asset size, this doesn't mean that larger credit unions do it better than smaller credit unions. What tends to be the reason that credit unions in larger asset categories have a higher loan to share ratio has more to do with the types of loans that they make. So in credit unions that are over $1 billion in assets, they tend to be able to make member business loans, as an example. Well, they can make member business loans, but a credit union that's 25 million isn't going to make member business loans. So there's a different there's different access, if you will, to the different types of loans and those sorts of things. There's also different dollar amounts. Maybe a credit union that can offer $1 million to do $1 million home loan and hold it on their balance sheet is going to be a little bit different than those that can't. So maybe it's types of loans, types of deposits, maybe it's dollar amounts of loans, dollar amounts of deposits. Those could all be things that are going to impact the loan to share ratio. And then we get to what's probably the most focused, the most talked about ratio for us in the credit union movement, which is ROA, or return on assets. And the reason that gets the most run, if you will, is because it's really how much net income are we making in relation to our average assets. Now, like I mentioned before, because that says average assets in the denominator, that tells you that it's what? A balance sheet based ratio or an income statement based ratio? Yeah, it's an income statement based ratio because it says average assets. If it said total assets, then that would be something that's derived from the balance sheet. And what I mean by that is because it says average assets and you know that's an income statement based ratio, that tells you where you're going to go find the numbers. I'm going to find net income on the income statement as an example. So just some different things to think about with that. As you can see, for us in the credit union movement, ROA, if we averaged it out, probably somewhere around 80 basis points. And one of the things about ratios is we talk about ratios all the time in terms of basis points. Basis points, 100 basis points is a different way of describing 1%. And it just makes it easier to talk in terms of basis points because I could say 1% if I was talking about 100 basis points. But what if I was talking about 80 basis points? If I wasn't going to use the word basis points, then I would have to describe my ROA as 0.8, right? So using the term basis points is a different way to describe percentages, especially when the percentages aren't whole numbers like 1 or 2 or 3 or something like that. Okay, so just think about that. When you see ROA on the screen, again, during the Great Recession, 2008, 2009, net income was very low. For us in the credit union movement, that's because we were creating and increasing the stabilization fund. But those 2 points in time aside, you can see that for us, over a period of time, it's about 80 basis points for us as far as what we make on a bottom line. And then, you can see that when we come down the asset scale of credit unions, we can see that there is a difference in the bottom line that we can make, or that we do make. And there are some examples of credit unions that have negative net income. And again, if you have negative net income, you can withstand that because you can get the money from undivided earnings. But if that becomes a trend where the bottom line is negative, that's where the problems are going to come into play. So the biggest reason that credit unions of larger asset sizes have a more favorable bottom line is because of operating expenses. And this is where we're going to get into economies of scale or efficiencies. So as credit unions become larger, they can achieve what is referred to as economies of scale. So when we look at this particular ratio, because the word assets, or sorry, because the word expenses is in the numerator, does that mean we want the ratio to go up or go down? Yeah, we want the ratio to go down, right? And so operating expenses, the biggest piece of operating expenses for every credit union is compensation and benefits, people. And the amount is not even close to as far as the second largest expense that credit unions have. But inside of operating expenses, you can find things like compensation and benefits, technology expenses could wind up there, collection expenses, loan servicing expenses. Those are just some of the examples of things that you can see when we see operating expenses. And what you see here on the trend line is the fact that operating expenses are basically fixed. So it doesn't matter what external interest rates do. It doesn't matter what our loan portfolio does or doesn't do, because the operating expenses for credit unions over extended periods of time, it tends to be fixed. So that's one of the things that you're going to want to dig into, as far as, if your credit union sees this trend where it's basically in a plateau, you're gonna say that in the write-up for operating expenses, or as it is referred to now, non-interest expense is the way it's referred to on the financial performance ratios. But whether it's operating expenses or non-interest expense, if you see the plateau for your credit union, the question is going to be, well, why? Why is that? Why have operating expenses always been right around 310 basis points, 3.1%? Assets have changed, assets have gone up, or maybe they've gone down, loans have gone up or gone down. So other parts have changed, but our operating expenses tend to remain fairly consistent. And then you could also talk about, if there's a plan inside the credit union to change that. If the credit union wants to get more efficient, what does that look like? How's that going to be measured? Those are all things that you'll be able to talk about as it relates to operating expenses. And this is economies of scale. So as a percentage of average assets, credit unions that are more than $1 billion in assets, the operating expense ratio or non-interest expense ratio is a lot lower than all other asset classes for us in credit unions. And that's what becoming efficient looks like. To use an economic analogy, what does it cost to produce the next widget? Well, whatever it costs, I want to be able to produce the next widget at the lowest cost. And that's what it means to become efficient, because now I can produce as many widgets as somebody else, or more widgets than somebody else, and it's costing me less money to do that. And the operating expenses, and this is important to mention, in your ratios project, ratio number 4 is called net operating expenses. So you're going to take operating expenses and then you're going to subtract out fee and other income. And so operating expenses is a part of that. And I mention this each year to the students. When you articulate that ratio number 4, net operating expenses, you can talk about what's happening with the operating expenses, what's happening with the net income. I mean, there's so many different things that you'll be able to talk about, because you're going to have to delve into, well, what's our non-interest income? What's our non-interest expense? Okay, so be thinking about that when we talk about it, when we're together during the ratios presentation. We're gonna go pretty deep. You're gonna bring your own credit union numbers that you're gonna get. So you're gonna look at your own numbers so you can start formulating, why have the numbers changed there in class, and maybe ask questions of your classmates, or maybe of me, and we can talk about different things. So operating expenses, definitely very, very important. And please note, for the pre-work, I'm showing you ratios. They're going to be in a different order when we get together. So just know that they'll be in a different order. Net interest margin. Net interest margin is the difference between what we make on loans and investments. So that's interest income. Because you have the word interest in there, that should draw your attention to the fact that these are rate related products. Okay, so loans and investments are what we're going to have to talk about. So how much money do we make? That's the biggest source of income for us in credit unions, is what we make on loans and investments. So I'm going to add those two together. That's my interest income. And then from that, I'm going to subtract out my interest expense. Now interest expense is a rate related concept as well. The rates come from the deposits and from any borrowings that your credit union has done. So if there's a rate on a liability account, then you're going to factor that in to interest expense. So what am I making on loans and investments minus what I'm paying on my cost of funds, my COF, and interest income, loans and investments, is also referred to as yield on assets, YOA. So I got YOA, interest income, yield on assets, minus interest expense, also known as cost of funds, COF. And the difference between those two is a net interest margin. And you can see, over time, the net interest margins have been coming down for credit unions. And the question that I always like to pose is, why do we suppose that is? Sure, some of it can be traced back to the fact that we've been operating in a decreasing rate environment for quite some time, but some of it's also going to be for other reasons. Maybe your credit union, maybe your specific credit union has become community chartered. And as your credit union has expanded out into communities, maybe the focus has been on attracting A credits, as an example, A and A plus credits on the loan side. Well, if I do that, though, that's going to give me, there's less of a charge-off risk, or not maybe, there is less of a charge-off risk. But then there's also the fact that I'm going to make a lower rate, a lower yield on those. And so really, really delve into, if the net interest margin's been coming down, why has that been? The biggest driver to that is going to be, what are you making on loans and investments? Okay. And so, yes, we've been operating in a declining rate environment for an extended period of time, but there also might be other things in there that we don't want to just gloss over. So that way, I can explain why I can answer the why question. Okay. And the net interest margin is important. Like we saw, net interest margin is what's the balance sheet is generating for income minus what the balance sheet is generating for expenses. Well, if we looked at those operating expenses, the operating expenses for almost every year are the same or higher than the net interest margin. And that's why non-interest income has become so important to us in credit unions, because we're not generating enough money from our entire balance sheet to cover the operating expenses of the credit union. Okay, so just think about that correlation. Think about net interest margin, operating expenses, and how they might relate to each other. And you can see, you know, the interesting thing for me is when you go down the asset categories, the net interest margin, it's not all that different. I mean, it's not all that different between smaller credit unions, larger credit unions, medium-sized credit unions. It doesn't really matter. I mean, you know, on average, we're all generating about the same amount of money, which is interesting when you think about types of loans, types of deposits, borrowings, investments that we can get into. At the end of the day, it doesn't seem to matter a whole lot. Across the credit union industry, we're generating about the same amount of money on our net interest margin. Okay, so think about that one. Then we're going to move back. I want to move back to some balance sheet ratios. So loan delinquencies, and when you calculate delinquencies, we're only looking at or thinking about loans that are 60 days or more delinquent. Now that's going to be of total loans. And so when we think about the delinquency numbers, so here on the screen, you can see that 2008, 2009, 2010, 2011 delinquencies were really high. The primary reason for that was because that was the first time the credit unions were having to foreclose on homes. And so that spiked a lot of the numbers. And so as we worked our way through that, and now we're on the other side, delinquencies are coming back down. But when you look at your credit union numbers, when you look at the dollar amount of delinquencies over 60 days compared to total loans, when you see changes, when you see spikes that have occurred in your 5-year history of your credit union, that's where we can go in and we can look at, well, what types of loans went delinquent? Maybe it wasn't so much the types of loans at all. Maybe it was the fact that we got a new collections manager, or we got more collections people, and that helped bring the number down. You know, maybe we had a change in philosophy on the management team, and maybe that caused the numbers to go up or go down. So there's going to be a lot of things that you can look at, focus on, and whatnot for the delinquency numbers. So just know that even though you can obviously tell me what the trend has been or what the trend is, I'm still going to be looking for the why. Why has the numbers gone up or gone down? Why have they plateaued? Why have they not changed at all? And if they've become delinquent, you know, or there's been an increase in delinquency, you know, maybe it could be, yeah, we had a big loan, we had a big first mortgage, or we had a big HELOC loan, and when that went delinquent, that caused the delinquency numbers to increase. So there could be, you know, a lot of different things that factor into it. And here's what delinquency looks like by asset category. And it doesn't really surprise me that as we go down the asset categories, as we get to credit unions that don't have a large number of assets, look, if you repo a car loan goes delinquent, well, that's going to have a pretty big impact or could have an impact on your numbers. So it doesn't necessarily mean that one asset class or one asset category for credit unions is doing better than another. There's just different things that can factor into it. Okay, so that's what delinquencies are going to look like. And delinquencies is a precursor to charge-offs. And charge-offs is really where we're going to get into what has hit the bottom line. Because for us in the credit union movement, when we charge something off, for a lot of us, our allowance for loan loss, that's what sits on the balance sheet. It's a reserve account. our allowance for loan loss is right where it's supposed to be. So when we have to charge off loans, that allowance comes down. And the way that we increase the allowance is through an account on the income statement that's called the provision for loan loss. The provision for loan loss. The provision for loan loss is an expense to us. And then that increases the allowance. So we take an income statement item, the provision for loan loss, and we use that to increase the allowance for loan loss. So as we experience more charge-offs, then that means we're going to have to increase our allowance. So when we get into net charge-offs, you can look at the trend, obviously, and you will, but you could also look at, well, why have we seen a spike in charge-offs? The net charge-off number is calculated by taking charge-offs minus recoveries. And so don't be surprised if there's a year, for most of us, that year might be 2021, where we had a negative charge-off ratio. So in other words, if we had a negative charge-off ratio, that means we actually got more recoveries than charge-offs. So one of the things that happened when we were in COVID was the fact that the courts shut down. So if we wanted to repo a car or foreclose on a home, we couldn't do that. Well, all of a sudden the courts opened up, and that allowed us to do a lot more of that. It allowed us to get a lot more recoveries in the door, on the books. And so when you make those calculations and you see an anomaly, like some of us are going to see when we do it, just take a step back and I can look at the numbers. I mean, I know I could see that we got more recoveries than charge-offs, but why would that be? And the biggest reason is there must have been something that was occurring that caused us, for this one moment in time, to get more recoveries than we had charge-offs. It's not going to happen very much at all. It's not going to be a trend that you're going to see. But when you see an anomaly like that, that would definitely be something that you would want to explain in the project. And so this is what the charge-off trend has been for us in credit unions. So as you can see, net charge-off ratios came way down in 2021. And so that would be something that we would want to hone in on. Just like if we saw a trend, like we saw back in 2008, 2009, 2010, we would want to make sure that we explain that trend as well. Why did that happen? Well, we were foreclosing on homes, because during the Great Recession, this was when people were holding multiple mortgages with the intention of flipping them. And so when the housing market crashed, people were caught holding more than one mortgage. So that's why they let a lot of them go bad. And then the credit unions foreclosed on them and sold them. And then that created a charge-off. So those are just some of the things that we can think about as it relates to net charge-offs. A couple more ratios for the pre-work. Here's the charge-offs by asset size, if you're interested. When we get into the liquidity ratio, now I want to be clear on this. So I mentioned loan to share ratio. So there's different ratios that we can look at for liquidity. So loans to shares, loans to total deposits, that's one way that we could look at the liquidity, because the higher that loan to share ratio goes, the more that tells us that our deposits are out in loans. And once a loan goes on the books, it's almost impossible to sell the loan. Maybe I can participate them out, but if I'm going to participate, if I'm going to do loan participations where I'm originating the participations, that has to be something that's in place. That has to be a process that already exists. But it certainly is something that can be done. But then there's also what we refer to as the liquidity ratio. The liquidity ratio is cash plus short-term investments divided by total assets. So because it says total assets in the denominator, that tells us that it's what? Balance sheet based ratio or an income statement based ratio? Yeah, it's a balance sheet based ratio because it just says total assets instead of average assets. So cash is what we have in our vaults, what we have in our ATMs. It's also what we have in our overnight accounts at the corporate credit unions, or maybe it's a bank. So in other words, that's the liquid assets of the credit union, the liquid money. So if I'm looking for money or I need money to run the day-to-day operations of the credit union, cash is what I'm going to look at to do that. And then short-term investments are any investment that's going to mature in 1 year or less. Any investment that's going to mature in 1 year or less. And that 1 year or less piece, that's the key to it. It not that it has the ability to be called, not that it has the ability to amortize like a mortgage-backed security. It literally has to be the maturity date is 1 year or less. So when you calculate this number, credit unions tend to have different numbers. Some credit unions have low cash plus short-term investments. Other credit unions have high cash plus short-term investments. And a lot of it's going to come down to the methodology of your credit union on how it's going to manage liquidity risk, because that's really what we're talking about here. So when you do that, you can talk about the ratio itself, why it has changed over time, but then you can also bring other things into play. So for example, you might see that we have a low cash plus short-term investment ratio for our credit union. And maybe that's because we have a lot of lines of credit at different places, at the corporate credit union, at the Federal Home Loan Bank, whatever the case may be. So it might be something to explain where here's why the numbers have changed. Here's why we're low compared to others, but here's also the things that we have in place that allow us to do that. And again, when you articulate this ratio, you want to relate it back to liquidity risk. If we had a liquidity risk situation come up, liquidity risk could be deposits are flowing out of the credit union. Liquidity risk could be loan growth is so high that we don't have the deposits to fund the loan growth. There's a maybe it's a confluence of both of those events. Maybe we see deposits flowing out while at the same time we have high loan growth. So whatever it is, you want to make sure that you relate it back to the liquidity risk position of the credit union and how we're going to manage that. Okay, so just a couple of things to think about before I end the pre-work. Just know this. So there's three types of risks that show up on or in a balance sheet. There's interest rate risk, credit risk, collateral risk. And interest rate risk is where you have longer term assets on your books. And that means I'm going to have to wait longer to get those loans or those investments to pay off. So interest rate risk is one of the things that we try to manage. And the outcome, if I have to wait longer for the loans or the investments to pay off, that could be one of the things that triggers liquidity risk. So much like if we were going to talk about credit risk. So if I said, we want to do more subprime lending, the first thing that would pop into your head is, well, then we might have more charge-offs down the road. And that could be true. So the charge-offs is the outcome of taking on more credit risk. Liquidity risk tends to be the outcome of taking on interest rate risk. So the third type of risk is collateral risk. And collateral risk is traditionally found in member business loans and second position mortgages. So whether they be fixed rate seconds or HELOCs. And all of those things have one thing in common. You're depending upon the collateral of the loan to secure, or the collateral of the business, the collateral of the house, the value of that to secure the loan. And so if the value of the collateral goes down, that could impact my loan that I have. So interest rate risk, credit risk, collateral risk, those are the three things that we find in balance sheet management. Okay, so just know when you're talking about liquidity risk, that's what we're talking about. That we might not have enough cash on hand to handle our day-to-day operations. So, what did we accomplish? We talked about ratios, how to calculate them, what's going to go into them. Again, you're going to make these calculations on your own. When you do the calculations, you have to show me the calculations. You can't just tell me for the ratio section that ROA was 0.75. You have to show me net income over average assets. What was the net income? What was the average assets? So that way I know that you actually calculated the numbers. So that's what we have for the pre-work. Let me know if you got any questions. Shoot me an email. And if I don't hear from any of you, that's okay, because I look forward to seeing you in a little while in Athens, Georgia. Have a good day.